The current trading price for Snowflake Inc., ticker symbol SNOW, is sitting right at $263.54, up by a significant $11.39, or roughly 4.52% on the intraday session. We are watching this chart move in real time, and the momentum here is palpable. The stock opened the session near $261 and is pushed as high as $268.21 in early trading. You are looking at a market cap that is aggressively flirting with the $90 billion mark, and the volume is already surging past 1.8 million shares. This isn't just a random Tuesday drift. This is a calculated, volume-backed move happening right now. But here is where we need to pause and separate the noise from the signal. The expectation right now, the narrative that is flooding every forum, every Discord server, and every financial news ticker is that Snowflake is surging purely on the back of general tech optimism and the upcoming earnings report scheduled for tomorrow, December 3rd. The expectation is that this is a classic buy the rumor event, where traders are piling in, hoping for a blowout quarter that validates the massive artificial intelligence premium baked into the stock. They see the price climbing 4% today and assume the coast is clear, that the market knows something good is coming. However, the reality is far more nuanced and, frankly, a bit more dangerous for the uninitiated. While the price action is bullish, the underlying mechanics suggest a massive tug-of-war. We are seeing major analyst upgrades hitting the wire, Rosenblatt pushing their target to $275, others eyeing $300. But simultaneously, we have significant insider selling, including a $6 million disposition by a key director just days ago. The reality is not just a simple buy signal. It is a high-stakes volatility trap being set right before a binary event. The market is pricing in perfection, and when you see a stock run up over 4% just 24 hours before earnings, you are looking at a scenario where the whisper number, the unofficial expectation, is becoming dangerously high. This isn't just about revenue. It is about whether Snowflake can prove it is the software layer that justifies the hardware spend we have seen in NVIDIA stock. Let's dig into the immediate price action we are seeing today. The stock is trading well above its previous close of $252.15. That gap up at the open is significant. It tells us that institutional desks were likely putting in buy orders overnight or pre-market, unwilling to wait for the opening bell. When you see a gap of nearly $10 right out of the gate, that is not retail traders on their phones. That is high-frequency algorithms and institutional capital positioning for a move. We are seeing the stock hold the 263 level firmly. It dipped to a low of $246 earlier, but rejected that lower price violently, snapping back up. That V-shaped recovery intraday is a bullish indicator for the immediate term, suggesting that dip buyers are incredibly aggressive right now. You have to look at this in the context of the broader sector. While many are watching Tesla stock for cues on risk appetite or looking at Apple stock for stability, the real correlation here is with the enterprise software stack. Snowflake is moving in sympathy with a broader bid for data infrastructure. The market has finally realized that you can't have an AI boom without a place to clean, store, and organize the data. You can buy all the chips you want, but if your data is a mess, your models are useless. That is the bid we are seeing today. It's an infrastructure play bid. However, let's talk about the volume. We are seeing volume pacing ahead of the average. If this closes near the highs of the day, specifically above $265, it sends a technical signal that the bulls are in total control heading into the print. But if we see a fade in the last hour of trading, if this slips back toward 255, it indicates that smart money is using this liquidity to exit positions before the volatility hits tomorrow. Now, why does this matter to you? Whether you are managing your own funds through a Schwab Intelligent Portfolio setup, using a self-investing strategy on an app, or handling a more complex individual brokerage account, The behavior of a stock like Snowflake acts as a barometer for the entire growth sector. It's a high beta name, meaning it moves faster and harder than the market. If you are into online investment, you know that these are the days that make or break a month's performance. The swing we are seeing, over 4% in a single session, is the kind of movement that triggers margin calls on shorts and FOMO on longs. Let's step back and look at what Snowflake actually is, because the cloud data warehouse label doesn't really cut it anymore, and that old definition is why so many value investors miss the boat here. The expectation is that Snowflake is just a fancy database in the cloud. You put data in, you run SQL queries, you get charts out. Boring, right? The reality is that Snowflake has effectively morphed into an operating system for enterprise data. With their data cloud architecture, they aren't just storing static rows and columns. They have introduced features like Snowflake Intelligence and native support for unstructured data, which is the fuel for large language models. Their business model operates on a consumption basis. This is critical to understand. Unlike a SaaS company that charges a flat subscription fee whether you use the software or not, Snowflake charges you for what you use: compute and storage. This is a double-edged sword. In a booming economy, companies run more queries, process more data, and Snowflake's revenue explodes without them having to sell a single new contract. But in a downturn, or when CFOs start scrutinizing their cloud bills, that consumption can be dialed down instantly. This usage-based model is why the stock is so volatile. It's a direct pulse on enterprise activity. If companies are building AI agents, they are burning Snowflake credits. If they are pausing projects, the meter stops running. Recently, the company has been aggressively pivoting to prove it is an AI platform, not just a storage locker. They have launched features allowing developers to build apps directly on top of Snowflake's data, bypassing the need to move that data out to other applications. This data gravity is their moat. Once a Fortune 500 company moves petabytes of sensitive customer data into Snowflake, the switching costs are astronomical. They are not leaving. This stickiness is what justifies the premium valuation multiples that often scare away conservative investors using Fidelity Wealth Management Services or conservative Fidelity mutual funds. Speaking of valuation, that is the elephant in the room. Snowflake has never been cheap by traditional metrics. It trades at a high multiple of sales, not just earnings. This is where the tension lies. Value investors look at the P/E ratio and run for the hills. Growth investors look at the durability of revenue growth and the net revenue retention rate, which has historically been best in class, and see a company that will grow into its valuation. Tomorrow's earnings report will be a referendum on this growth. The market needs to see that retention rate stabilize. If existing customers are spending less, the stock could be punished severely, regardless of how many new customers they sign up. Let's pivot back to the live action and the institutional flows. We mentioned the insider selling earlier. It's important not to overreact to every insider sale, as executives often sell for tax planning or diversification, sometimes facilitated by automated 10b5-1 plans. However, when you see a director selling millions worth of stock right near a local high, it does signal that they do not see massive immediate upside from that specific price point. It's a reality check. It tells us that while the long-term story might be intact, the short-term price might be getting overheated. On the flip side, we have seen institutional accumulation from major funds. When you look at the ownership structure, it is heavy with the likes of Vanguard, BlackRock, and other giants who manage the ETFs you might find in your Fidelity ETFs or SoFi Invest portfolio. These institutions are not day trading. They are building positions for the next 5 to 10 years. Their continued presence suggests a belief that Snowflake is a foundational piece of the future technology stack, much like Oracle was in the 90s. The narrative right now is also heavily influenced by the macro environment. We are in a period where interest rate expectations are fluctuating. High-growth stocks like Snowflake are long-duration assets. Their value is derived from cash flows far in the future. When rates stay high, those future cash flows are worth less today. But with the market sensing a potential softening in rates, or at least a peak, risk-on assets are flying. This macro tailwind is aiding today's 4% move just as much as company-specific news. I want to take a moment to address the retail investor watching this. If you're sitting there with your Robinhood app open or checking your Interactive Brokers account, you might be tempted to chase this candle. The fear of missing out is powerful when you see green numbers flashing. But professional trading is about risk management. Entering a full position right before an earnings event is akin to gambling. A more prudent approach, often discussed in investment help circles, is to wait for the reaction. If the numbers are good, the stock might gap up, but you will have confirmation. If they are bad, you avoid